What if you could produce consistent monthly cash flow while only needing 10 minutes of your time per month? Now, normally we hate on principle saying anything like I just said. But in this case, there actually is a simple but unique option strategy that allows you to do just this. And in this video, our head of options trading, Seth Freudberg, will be teaching it to you in detail. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. We hope you agree. This is the top YouTube channel to help you grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And we hear from traders and investors all over the world that are looking for better ways to generate cash flow than the normal methods that most investors use, which are comprised of, debt instruments like bank certificates of deposits or bonds, which have improved lately but are still yielding at best around 5% for investment grade bonds, or alternatively, you can go into the stock market, which is even worse. The average yield on component stocks of the S&P 500 today is less than 2%. And so if 2 to 5% returns just don't produce the kind of cash flow you need to make from your investments, then are you just stuck? And the good news is that you most certainly are not stuck. And in fact, there's an option strategy that has the potential of providing you with returns way beyond what you can generate through the income from stocks and bonds, and that's what we're going to be teaching you in today's video. Now, if you're new to options trading and don't know what stock options are or how they work, we've created a video for you to understand options basics, and if you click the video appearing on your screen right now, it will lay the groundwork for understanding the strategy we'll be teaching you in the video. Then, when you're finished, you can come back and watch the rest of the video. Okay, so the strategy we'll be teaching you today is a version of what options traders refer to as the wheel strategy, which is a strategy that you should only use on stocks where you have a long-term positive outlook, even if your short-term outlook isn't particularly bullish. And we're going to be providing you an example through taking a look at how you could have implemented this version of the wheel strategy using Caterpillar stock, which trades under the ticker symbol of CAT. And as you can see, about a year ago, CAT had started the year strong, rallying as high as 237, until in April, the stock had started to sell off, and by September, had dropped to just over 180. And so suppose that on September 2nd, at the market close, we went ahead and sold a 175 put, a strike price right below where CAT was trading, and we sold it for a price of $4.92, as you can see from the options chain. And so let's make sure we're clear on the cash flow of what just happened, because when you sell a put for $4.92, you multiply that by 100 to calculate the cash you receive, because each put option represents the right of the put buyer to sell his shares to you at $175 per share. And so that results in $492 of positive cash flow at the outset of the campaign, for which your broker will require you to have at least $17,500 in cash to cover the possibility the CAT would close below 175 on the day it expires on October 7th, in which case you'd be assigned the 100 shares at 175 per share by the one who bought the put from you a month earlier. And so at this point, you might be wondering why we chose the 175 strike. And the reason is that we've decided that we're going to try to receive at least a 2% return on the capital that we need to put up each month as required by our broker. And so in order to attain a return of 2% or more, we need to sell that put right below where the stock is trading, that put at 175. And since the broker will require $17,500 in cash, as we just explained, we can see that $492 represents 2.8% of that. And so that meets our 2% criteria. Let's move to October 7th on the day that this option expires. And as you can see, CAT closed at 177.55 that day, and so our put option down at 175 simply expires with no value. Now, what that means is that the $4.92 that we received for the option, we just get to pocket that cash. And so since this is going to be a campaign, we've created a scorecard for the campaign, and we're showing you that since the put option expired with no value, the put just dies and goes to options heaven, and we just pocket that cash flow. Okay, so now that that part of the campaign is over, it's time to start the next month of the campaign. And in this case, we found that with the stock trading at 177.55, we can sell the 165 put expiring a month later on November 4th for $3.67. And as you can see, that option also meets our standards as well, bringing in $367 against the required 16.5 in capital, resulting in a 2.2% return for that month's trade. Okay, so now moving to November 4th, the day the new put option expired, you can see that CAT had a really nice rally that month. And so by November 4th, the stock had climbed up to 227.85, which is well above our 165 put option, and therefore that option, again, expires worthless. And so now updating our scorecard, you can see that we've racked up another month where we just pocketed the cash flow we first received when we entered the trade. And so the campaign just proceeds like that, opening up a new put every time the previous one expires. And as you can see, with CAT rallying, our campaign has been very successful so far. But then something happens during the April trade, which, as you can see, was positioned at the 250 put strike. But this time, instead of CAT rallying, it sold off sharply, closing at 209.17 on the day that the option expired. And so when that happens, the put buyer exercises his right to sell us the shares at 250, and we now own 100 shares of CAT. All right, so all along you've probably been wondering, why exactly is this called the wheel strategy? And so when you see what happens over the next several months, you're going to understand exactly why we call it the wheel strategy. So let's think about it now. We own 100 shares of CAT. And so what exactly can we do at this point to earn cash on those shares? Well, in this version of the wheel strategy, what we're going to do to bring in some cash each month is we're in the ownership stage of the wheel strategy where we own the shares of CAT. What we'll do at this point in this technique is to sell a call spread where the short call closer to the market is located exactly at the price we bought the 100 shares at 250. And we will then buy the next strike up, the 255 call, forming what options traders referred to as a call credit spread. And we made sure that the strike price of the short call was exactly at the same price as we paid for those shares. And you'll see shortly why we were careful to sell the short call portion of the spread no lower than that acquisition price of 250. And so from this point in the campaign, if CAT doesn't close above 250 on the day that the call credit spread expires, then we'll just sell another call credit spread in the next month and pocket the cash we first got selling that call spread a month earlier. Again, selling a call credit spread with a short strike of 250 and a long call of 255. And so let's move forward to May 5th. And as you can see, CAT basically didn't move after a month, closing at 215.09, which of course means that both the 250 and the 255 calls expired worthless. And so the $9 we got for selling that call credit spread simply expired worthless, as did the short puts in the earlier phase of the wheel campaign. And so updating our scorecard, you can see that we collected that 510 for April, but as a result of the assignment of the shares, we now own 100 shares of CAT. So in April, as we just showed you, the call credit spread was initiated for May options, and those expired worthless, leaving us with the $9 that we initially collected for that spread. And the same thing happened in the case of the June and July credit spreads that we sold. And in both cases, as you can see from the table, the stock closed below 250, and the call credit spreads again expired worthless, resulting in very small amounts of income from those 2 months. And then something very, very interesting happened after that. You see, after the call credit spread expired in early July, we entered into yet another call credit spread with the short call at 250 and the long call at 255 for the August expiration, just as we did the prior 3 months. But this time, CAT rallied, and it rallied hard, closing at 276.44, way above the short call at 250 and the long call at 255. And so that gave us an incredible opportunity, which was to just let the short call expire, which means that our shares will be sold to the one we sold the call to for $250 a share, exactly what we paid for them months earlier. And at the same time, we have that long call at 255, which has now become super valuable because that long gives us the right to buy shares at 255, which are now worth 276.44. And so the value of that call has now gone up to almost exactly the difference between 255 and 276.44, which was CAT's closing price. And so we can get over $21 for that option because that right is now worth over $21 with CAT trading more than 21 points above 255. And so we sell that off for the price, as you can see, of $21.44. And so just to be clear, that brings in $2,142 by selling that long call portion of the call credit spread. Meanwhile, our 100 shares are gone, and we've experienced neither a gain nor a loss from those shares because we bought them originally as a result of our short put being exercised, and we sold them this month as a result of our short 250 call being exercised. So those shares came and went with no effect on us at all. Okay, so now the final month of the campaign is September, and since we don't own the shares anymore, we return to selling a put for 2%, which in this case is the 275 put expiring on the 1st of September for $6.20. And as you can see, CAT expired at 286.25 on the 1st of September, resulting in another case of the put just expiring worthless. And so when we take stock of the entire campaign, you can see that every single month we did make positive cash flow, although when the shares were assigned and the call spreads were being employed, we made very little. But by remaining persistent and staying with the writing of those call spreads every month, we ended up having the shares assigned away from us with no loss on the shares. But we experienced a big win from the fact that we owned that long 255 call and made a nice profit on the entire campaign when we add in the cash flow from selling the puts and later the call spreads, plus that very nice gain on the long call in August, resulting in a final campaign profit of $6,465, which is a return of over 25% on the average amount of capital that your broker would have required during the campaign, which was $25,600 on average. And all of this is done spending barely 10 minutes per month managing the trade, as the steps are so incredibly easy, as you can see. And so now you know why the strategy is called the wheel. You start out selling puts, and if those puts get assigned shares, then you start selling, in this version of the wheel, call credit spreads where the short call is located at the price you were assigned the shares. If the stock does bounce and your shares are called away by the short call, then your temporary ownership of those shares became literally irrelevant. You broke even on them. And instead, you calculate your profit based on how much you made selling the puts, plus the call credit spreads. And if you have a runaway rally while selling the call credit spreads, as happened in this case, you can make a big profit on the long call portion of the call credit spreads, while your short call just triggers your shares being sold at a price which is harmless to you, resulting in many cases in a terrific return, as happened in this case. Finally, you resume selling puts again and returning to how you started the strategy in the first place, and that's why it's called the wheel strategy. The wheel is an example of the many creative kinds of strategies that professional options traders have at their fingertips, and hopefully you can now benefit from us sharing that knowledge with you.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition, the traders in this room. This room right here is full of elite traders, some of whom are making 7,
and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we've found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training.
That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part? You don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.